Okay, hello and welcome. As you can see on the screen, we have some screenshots of Nasdaq futures going into London session. I'm going to be breaking down that expansionary leg higher, how it was anticipated, and ultimately how it came to fruition. So we have the daily chart here, and that London session expansion took place inside of this Thursday candle here. And the framework and the general bias of that anticipated move intraday intra-session came about by forecasting and understanding how this candle should form and how and where it could potentially reach for with the highest probability. So this is the daily chart. And let's just break down this intra-week sort of information data that has printed. So we have our new week opening gap, and this daily candle here is actually Monday, Tuesday. It's squeezed into one candle because of the US bank holiday. But anyway, the week opens, price displaces lower, closes beneath an old low, and has lower sell side liquidity in reach. However, that Wednesday candle opens following the Monday, Tuesday candle, trades lower, absorbs the sell side liquidity beneath Monday, Tuesday, sweeps it, does not close below, but rallies to the buy side, takes out the Monday, Tuesday high, and closes above 50% equilibrium of that Monday, Tuesday candle. That sort of information, feedback the market has provided as information, not as a subjective thing, what I want the market to do. What I'm seeing here shows me that this market can continue reaching to a higher premium in the realm of that new week opening gap and potentially whatever is there on the lower time frame. So let's go a bit lower and see what else is there. Here we have the 4-hour chart, and I'd like to direct your attention to this volume imbalance here. This is the futures rollover new day, not the true new day at midnight. So as you can see, the following candle, 4-hour candle, that forms, opens, trades into the volume imbalance, and closes above it as well as the previous low. And you have to remember this 4-hour time frame is so crucial as they hold entire sessions, really. Nearly is this candle here the entire Asia session, opening at 10 p.m., closing at 2 a.m. However, the following candle, this is the expansion that I forecasted, right? It holds the entire Asia session, opens at 2 a.m., closing at 6 a.m., going close into New York session. So having the same sort of foundation from the daily chart, manipulation and absorption of sell-side liquidity beneath our previous candle into our discount here, our volume imbalance, it's now setting up a move. There's different phases in the marketplace and different market profiles, right? We have consolidations, expansions, right? Consolidations bring expansions that bring consolidations, and it's an endless loop, right? So understanding this is going to give us an idea of future expansion, right? We are anticipating expansion, and that's when we want to be actually trading and risking equity, right? We want to have that volume and volatility on our side. That's why it's so important to be looking at these higher time frame charts. As in the lower time frame, we're just aligning ourselves within those flows and riding them higher or lower. So here we are on the 15-minute chart. From the daily time frame, we've established we want to see that daily candle open and expand higher in terms of reaching that new week opening gap, which we have here. And now going into the lower time frames, we're here to identify what other draw on liquidity or rebalance, mitigation could we reach for that should magnetize price and allow price to gravitate towards. As well as our 4-hour chart, we had that 10 p.m. candle, which we see opens here, trades lower into our volume imbalance, and closes at 2 a.m. And you can already see with the daily, right? Just to depict it here, say this was that first candle, price opens, trades lower, and expands, right? This is how moves are engineered in the marketplace, right? A level of consolidation, the market manipulates, and then further looks to distribute, right? Your profit release phase, right? Consolidations bring expansion, consolidation, expansion. That is the everlasting flow of the marketplace. That is how orders are accumulated, how orders are paired, and how they're released, right? Expansion. And that's what we want to align ourselves within, right? Expansion. So we see in the marketplace during these times of consolidation, how orders are being paired, how the market is being engineered to allow this flow of release of liquidity, right, into the marketplace. So even now we have our 4-hour close. We are opening a new 4-hour candle at 2 a.m. Now it's okay. We understand we have a higher draw. And I want to note these actually as well on the 15-minute. Here we are. We have relative equal highs, right? We're making lower highs here. We have an Asia high and we have our previous day high. We don't see sharp moves higher with breaks lower showing it hard, a high resistance liquidity run. We have smooth highs. Got interrupted for a sec, but let's get right back into it. So now we have our New session open, London session at 2 a.m. We have our new 4-hour candle forming. We're anticipating expansion. We have our draws on liquidity. We have an area here we understand where price should gravitate towards, our relative equal highs, our smooth low resistance liquidity run, our new week opening gap. Now it's a matter of sort of not when price should reach for it. We understand during that London session, right? But how do we sort of qualify trade that price is ready to start moving higher and not sort of move lower, take this low again and expand? Because we do have lower discount valuation, right? With an FVG, an imbalance lower. We have unmitigated accumulation down here. And this is something I used to think about earlier as a trader, is to know what price should actually qualify before starting these expansions, right? Like what levels to trust, really, right? You have to understand all of these sort of arrays, all these levels are reference points, right? And that the price is going to reference to move to a different level of valuation. So let's take a look at the 5-minute chart. And we're going to use time to our advantage, midnight open, as this line depicts here. I'm just going to get rid of this indicator. So just as said with the consolidations, expansions, with midnight open here, you're going to use that as an indication when you're anticipating up days, anticipating down days. You want to see that accumulation take place below midnight. On your down days, you want to see that accumulation take place above midnight. This is midnight open, to have that displacement further take place. So understanding different market profiling and what the market's really doing at certain times, and being able to anticipate what shall happen based on time, based on, say, the daily candle, the 4-hour candle, your objectives, you can really piece things together and have a very good idea and a great skill set of reading price. Because price isn't just doing nothing here. You may think this is a boring market. We have a consolidated London session. But if you really look at things, you'll understand that it is indeed accumulating to fuel a move higher into the premium. So speaking about reference points and which to sort of use and know what price will trade off of and qualify, you want to look at you want to look at speed, displacement from these reference points. Is price utilizing it? Are orders being paired to move to that next valuation point? Let's take a deeper look at this accumulation here. You can see our reference point, that new day opening gap. As we're below midnight open, we see that we deem that as accumulation. Price picking up speed after 2 a.m., after that candle has opened, the candle that we anticipate displacement and expansion to take place in. On the lower time frames, once we see displacement higher, we're going outside above that midnight open. We're seeing gaps form in price action. We're seeing closures above these down candles that fuel these accumulations. We can understand that the pricing model is now starting to shift, right? If institutions, smart money, whoever's controlling the market, right, is buying in these discount prices, right, pricing in these down moves, like that previous 4-hour candle, pricing in these down moves to buy, they're not going to want to bring price lower and put those long positions in drawdown, right? They're going to want to leave this area with speed, right? So it's the footprint, the institutional footprint in the marketplace, displacement out of a reference point, forming imbalances towards available liquidity. And that's what you're trying to align yourself within. And as you see here, price does indeed expand to the buy side. When you really start to piece things together in terms of anticipating that expansion from maybe your daily, your 4-hour, your higher time frame charts, where price should reach for before that expansion, your reference point, and when price should do it in terms of session, above midnight open in terms of London session, the aspect of time. When you sort of piece things together and see the market as just information, as data that's being printed, and you're responding to it. It's if-then scenarios. If the market does this, if the market trades below midnight open and we see expansion and closure above the down move, we can expect what to happen, further upside, things of that nature. It's very easy to get emotional reactions in the marketplace by spontaneous movements, your own equity at risk in that nature. That's why trading has so many aspects. You're not just a trader who's buying or selling. You are an analyst. You are a professional money manager. There are so many aspects to it that you can't just not shine a light to, right? All of those aspects as a conglomerate make you the trader, right? So you need to develop all those as a whole in order to be a master, truly. So that's the breakdown of that London expansionary move higher. But even looking at further price in hindsight, just to break things down, saying new sessions, as said, I mean, new sessions bring new pricing models. Now going into New York, right? Sort of even 7 a.m., 8:30 here. As I said, consolidations bring expansions. You can see as price going into that transition from London to New York comes into consolidation as we've reached those buy-side targets, right? A new pricing model is being built. There's consolidation. Now price runs in a deep, deep premium intraday. Retail traders, the majority will see that as maybe a time of buying. Price is so bullish intraday. When the true New York session opens, when there's a load of liquidity coming to the market, price enters that new pricing model, you can see price just comes exactly back to where it initially accumulated, right? It's priced in, it's algorithmic, exactly to where it accumulated earlier. Whoever's buying up here gets dragged down to a discount, maybe their stop loss under this low, and they start selling with these big moves, but they don't understand price is just rebalancing, right? It's mitigating what it earlier did. The accumulations, maybe they put shorts in to price in this discount to buy. When these institutions are long, they need to close out these shorts, right? They'll be in drawdown if this market continues higher. So they'll close those shorts from earlier in order to bring this market higher eventually. And you can see the same thing here. Where did price distribute the accumulation of shorts, right? Where smart money maybe not even entered short, but closed their longs, right? In this buy-side liquidity. But as this is a place of facilitation, just as was here, price gravitates towards it, price gravitates towards it here. So it's a footprint in price. You want to really mark these levels of consolidation and how price moves away from it and sort of the gaps in price action that it leaves and whatnot. But yeah, ultimately I just marked this level off to sort of end the week as a potential end week draw, and you can see price reaches it exactly and gets brought back into the range. Let's check out what that reference point is exactly. You can just see it. It's the same thing. A run on a high, an accumulation, a manipulation, and expansion lower, right? So there could be old longs in here that institutions bought up this move to price in the discount intra-week. Second here. To just bring price right back up. Price in a discount, get everyone short. They'll buy those shorts, right? Smart money, counter trade. To facilitate a trade, there needs to be a buyer and a seller. Price this market back up. There's all footprints to this, right? So you just have to understand the general framework and the ideas behind what's really going on. And just another interesting thing, you can see here my price reaches that premium reference point. And you'll see a lot of times, especially Friday, price will close right at equilibrium, right at 50%. Price does its job, it reaches the premium. Anyone who's even buying long, thinking price is so bullish, they'll just drag them back into the range, right? Stop them out and close the week. But yeah, I hope you enjoyed this video and got some value out of it. I just wanted to break down this expansion here and how acquiring different information and being receptive to new data that's taking place in the marketplace in terms of candles printing, how you can form decisions from there and how they can confluence each other to trade with the highest probability within the flows, within the volume, intra-week, intraday, intra-session. Thank you so much for watching. Have a good one.